Let's remind ourselves of the debits and credits. Debt is the mnemonic for dividends, expenses, assets, and drawings. Those items are normally recorded as debits. Mnemonic LI stands for liabilities, income, and equity. Those items are normally recorded as credits. If you think about debits and credits in another way, when company receive or will receive something, it becomes a debit. When owners receive or will receive something, it becomes a debit. When company pay or will pay, it becomes a credit. When owners pay or will pay, it becomes a credit. So on the accounting equations, assets equal liabilities plus equity, asset category is normally recorded as debits. Liability category is normally recorded as credits. Equity category normally recorded as credits, but equity can be expanded as owner's capital, drawings or withdrawals, and dividends, revenue and expenses. Owner's capital are normally recorded as credits. Dividends and drawings are normally recorded as debits. Revenue and expenses contribute to equity. Revenue is normally recorded as credit. Expenses are normally recorded as debits. Having learned that principles, those guidelines, debt and lie, debt are normally recorded as debits, lie are normally recorded as credits. There are exceptions. Expenses normally recorded as debits, but exceptions are purchase discounts, purchase returns, and allowances. Those are normally recorded as credits. They are exceptions. For income or revenue, sales discounts and sales returns and allowances are normally recorded as debits, which is an exception, because income or revenue or sales are normally recorded as credits. So when we talk about discounts, returns, and allowances, they are called contra accounts. They behave in an opposite way to the normal accounts that we expect in that category. So for expenses, they behave differently. It's a contra account, they become credit items. They are credit entries. Purchase discounts, purchase returns, and allowances. And for sales discounts, sales returns, and allowances are contra entries. They are normally recorded as debits. So purchase returns are normally credit. Purchase allowances are normally credit. When there's a purchase return, we record it as a credit, and when the purchase return is received, it also reduces the accounts payable. The effect of that is that accounts payable reduces because the money that the company will have to pay the supplier also reduces because the company has returned some purchases. Same with purchase allowances. Accounts payable reduces, decreases because the company will get a concession on the payment for not returning the items. For the purchase discounts, the discount received from the supplier, it is a credit. It is recorded as a credit item. And that will reduce the cash payment. Accounts payable will not reduce. We're supposed to pay so much, but the amount of cash that we will pay as a company will now reduce because of the discount received. Again, purchase returns, purchase allowance, discount received on purchases are credit items contra accounts. So when we look at inventory, the purchase returns, because they are credit items, they are going to reduce the net inventory. For example, the company bought $200 worth of inventory and returned $50 worth of inventory, then the net inventory becomes $150. So 150 is the net inventory, and for that the company has to pay. But if the company receives a discount for that payment, the cash payment will now reduce. Company is supposed to pay 150, but it will pay cash 147 because a discount was received. Sales returns and allowances are also contra accounts, just like purchase returns and allowances. The sales returns are normally a debit balance, and sales allowances are also normally a debit balance account. Sales return is where the goods are returned by the customer to the company, and sales allowance is customer keeps the good, but the company will grant a concession on the sales price. Sales discount again is a debit balance. It is a discount that is given to the customer so that the customer will pay early and settle the account. The sales returns decreases the net sales. So let's say the gross sales was 500 and the customer returns $100 worth of goods. Then the net sales becomes 500 less 100, 400. It decreases the gross sales by so much. The discount receipt. The discount is given to the customer, and the company should receive $400 Because the customer is given a discount of $8, the cash that will be received will be $392.